So the three important in financial statements are cash flow, profit loss, and balance sheet. I believe those are the three. So these are really important for us to look at when looking at a company's earnings. They each tell us a certain aspect of how the company is doing. All right, so we will get started analyzing a company's earnings. Okay, so today's learning target is how can we correctly evaluate a company based on its earnings, and how can we correctly evaluate a company based on its earnings when we're making an investment, when we're doing fundamental analysis. Okay, so the first one we're going to talk about is the numbers game. A lot of companies like to play around with the whole accounting game, and in their financial statements where we talked about the balance sheet, profit loss, or cash flow, there's a lot of manipulation that companies can do. So the first type of manipulation is probably to compensate heavily through stock options, where a top executive realized that they could become very, very rich by just increasing their company's earnings for a few years running. So we're going to teach more about that in later classes. Basically, trading stock options is you're buying, let's say, 100 shares with the price of even less than one or a little bit more. It depends on what company you're trying to buy or the expiration date. So this basically allows the investors to buy more shares than that it is published on the market from the company, and that makes a lot of money for the company. So that's one. Another one is like hundreds of companies violate the spirit of accounting principles. They turn their financial reports into gibberish or tarting up ugly results with cosmetic fixes, or clocking up the expenses or manufacturing earnings out of the thin air. So they can make up a lot of things on their reports. Of course, a lot of things they put in can be legal, but most of the time it is really hard to recognize that it is illegal. And also companies like to format their reports in a certain way for you to not see some things. So today we're going to be talking about examples of that, and that could be really interesting if you can catch those errors. All right, so we're gonna start today with, of course, opening up our meeting regarding what we're teaching about and also things that we should watch out. The second thing we're going to do is we're going to be teaching through stories. I'm gonna tell you guys stories of what happened in the past and how that have affected investors' decisions and affected the companies. Okay, as if. Today we're going to learn the term pro forma. Pro forma earnings is a financial statement or a financial report based on hypothetical scenarios that utilizes assumptions or financial projections of a company. So you're basically trying to assume certain things about a company to predict their earnings. So perhaps the most widespread bit of accounting was the pro forma earning fad. So there's an old saying on Wall Street that every single bad idea starts out as a good idea. So everyone thought it's a good idea, but then it turns into a good idea. So pro forma earnings is one of those. So they thought it's a good idea, but it's actually not. So the original point of pro forma was to provide a a better picture of long-term growth earnings by adjusting short-term deviations from the trend, or supposedly like non-reoccurring events. So a pro forma press release might, for instance, show a company would have earned over the past years if another firm it had just acquired have been part of the family for 12 months. It's like really random assumptions. So in the 1990s, companies just don't leave enough alone. Like we can take some examples. So for the first point, it says, for the first quarter ended September 30th, 1999, InfoSpace presented its pro forma earning as if it had not paid 191 159.9 million in preferred stock dividends. So it's assuming a lot of factors that just did not happen, and they would put these bold statements on their financial statements called the pro forma release. And as an intelligent investor, all you just want to do is to ignore the pro forma earnings. So this is not one of the three main financial publications. So if that ever come up on your feed, or a company asks you to look at their pro forma, what you want to do just to ignore it within your investment decisions. All right. Okay. So the next one example is I'm going to talk about the company Quest. They were very, very hungry for recognition, and they manipulated their financial reports. So in the 2000s, year 2000, Quest Communication International company, the telecommunication giant, they looked really, really strong. Their shares dropped less than 5%, even as the entire market dropped more than 9%. So even though it dropped, it's better compared to the entire rest of the stock market. So that made the company look really, really good. But Quest's financial reports held an odd revelation. So in the late 1999, Quest decided to recognize the revenues from its telephone directories as soon as the phone books were published, even though, as anyone who has ever taken out, let's say, a yellow page advertisement knows, many business pay those ads in monthly installments. Like, they don't pay it all at once, they pay in monthly installments. But this company reported all its potential earnings, and that pumped up their net income by 240 million after taxes, which is a fourth of all the money that they earned last year. So they pumped up their net earnings. So a little chunk, it's just they try to increase their earnings with the money that they don't actually have. And what happened was, by the early 2003, after reviewing its previous financial statements, the company announced that it had prematurely recognized profits and equipment sales, and they have improperly recorded the cost of services provided by outsiders and inappropriately booked costs as if they were capital assets rather than expenses, and admitted that they have unjustifiably treated the exchange of assets as if they were outright sales. So all told, Quest revenue for the year 2000 and 2001 have been overestimated by 2.2 billion, including 80 million from the earlier a situation where they tried to manipulate their income statement. So what ended up happening is, at that time, Quest was one of the 330 public traded companies that have restated past financial statements, that have made a mistake in their statements. We don't know if it's on purpose or not. So what happened to the company itself? At the end of the year 2000, when they reported that, their stock per share was traded at $41. 3 years later, by the early 2003, their stock earning was around $4, valuing the company less than 7 billion before, and they suffered a 90% loss just due to the simple, overestimation or manipulation of their financial statements. And that's something that you should watch out for when looking at financial statements, because when companies overestimate, they will write in their financial statements like, okay, so this includes all the monthly installments that have not been in our account yet. But that text might be written so little that it's in the footnote of the number. For example, like if I were to type on the screen, okay, so I can't really type on that today because there's a technical issue, but let's say, for example, hungry for recognition, this is their title, right? And then they will put a little number, like a tiny number above recognition, like 1, and they will put a tiny text below as a footnote to explain, oh, these earnings assumes that we have already profited from the magazines that have not paid us the telephone fees yet. Yeah. Okay, so this is hungry for a connection. This is one example of how a company can manipulate their financial reports. The next one is an inventory story. So in the 2000s, many makers or factories of semiconductor chips, there are a type of technology chips that you put that is used for war weapons, for phones, etc. Technology company. They're called the Micron technology. So um, Micron technology was one of the factories that suffered from like a loss in demand. And in fact, Micron was hit so hard by the plunge, the drop in demand, that it had to start writing down the values of its inventories, since customers clearly did not want them at the price Micron had been asking at the time. So in the quarter ended in May of 2021, so probably May of 2001, not 2021, May of 2001. So right here, right? So right here, Micron slashed a record inventory up by 261.1 million. So I think this is how much they write down, right? Look at this column. So this is how much they wrote down in terms of millions. And most of the investors interpreted this write down, like this loss, as a normal or reoccurring cost of operations, but as an unusual event. So they think this is not because it's lost in demand because the company couldn't sell any products, but maybe it's because the company is starting a new store or starting a new factory, investing in a new sector. That's why they didn't make as much money. So they wrongly interpreted their write downs. But if you look at what happened, their loss increased, right? For the August of 2001, the write down is up to $465.8 million. So Micron booked further inventory write downs in every one of the next 6 fiscal quarters. Was the devaluation of Micron's inventory a non-recurring event, or had it been like a chronic condition? So reasonable minds can differ this particular case, but one thing is very clear, that the intelligent investor must always be on guard for non-recurring costs that just keeps going. So we assume that this won't happen again, but it just keeps going. There was significant loss in all these quarters, except for this one. But in recurring events, there are exceptions. You have to recognize that the recurring is a loss, not a gain. Not these. This is what we want to see, but it's still right down 3.8 million. All right. So that was another example. So how do we avoid these issues? How do we overlook? How do we take a closer look at these financial statements? So how do we avoid buying a stock that turns out to be an accounting time bomb? A few pointers will help you to avoid buying stocks. These kind of stocks. So first is reading backwards. When you research a company's financial report, start reading on the very last page and slowly work your way towards the front. Anything that the company doesn't want you to see is buried in the very back, which is precisely why you should start looking from the back first. There's a company I've worked with before, and they are a publicly traded company. So of course, every single quarter they publish financial reports. And in the beginning, they have all these flourish stuff. They talk about a quote from the CEO, a quote from the president, how amazing their year have been, what their future onlooking is, and at the very end is their profit loss, what they've been suffering, etc. It is legally required by the IRS and the SEC to report every single earning. So they'll have to put it somewhere, right? Usually they put it in the back. Okay, so the second point is to read the notes. As I said before, never buy a stock without reading the footnotes of the financial statements in the annual report, usually labeled as a summary of significant account policies. Some keynote describes how the company how the company itself recognize value, revenue, record inventories, treat installments or contact sales expenses or market contract or all the other aspects of business. So what I'm saying is each company have their different way of interpreting what they consider as revenue, what they consider as loss, what they consider as liabilities or profits. And those things, they're all detailed in the footnote. And that's really important because a company might assume a building that they're not using and not renting out as an asset, while others might interpret it as a liability. Obviously, from my perspective, it's more of a liability because you're not using it or you're not making income from it. But that's where you want to put your own evaluation in. But remember to read the footnote. So in the other footnotes, watch for disclosure about debt, stock options, loan to customers, reserve against losses, and other risk factors. They will say like A, B, C, and other risk factors and put a little number and put it in the footnote. So that could be a big chop of earnings that they're not even talking about. They just put other factors. It's the same as Coca-Cola when you say, oh, and other natural flavoring. It's kind of the same idea. So among the things that should make your alert, that should alert you, like technical terms like capitalized, deferred, and restructuring, and plain English words that signal the company has altered accounting practice, like they began or they change or they. However, none of these words means that you should not buy the stock, but all mean that you need just to investigate further. Be sure to compare the footnote that's in the financial statement of at least one firm to another firm that's a very close competitor. For example, you might want to compare Microsoft with Apple, or like Chick-fil-A with like Wendy's with McDonald's. Like you can look at their footnote and compare them and compare their financial statements. This will really enhance your analyzation of the financial reports. So the third helpful point is to read more. So all of these read. Yeah, analyzing financial statements and fundamental analysis, it's a lot of reading, news reports, etc. So read more. So if you are a very serious investor who is willing to put plenty of time and energy in your portfolio, the only way then you probably like owe it to yourself to learn more about financial reporting. So exactly how companies report their statements, because by understanding how they make the sheet, it will help you to understand how to read the sheet. So that's the only way to minimize your odds of being misled by a shift in earnings statement or a little manipulation of terms or wording. So 3 solid books that have specific examples I will recommend to you guys is these 3. So the financial statement analysis workbook, this actually have examples where you can practice like reading. And the second one is the financial number game. So like all the manipulations and the games that accountants might play to bribe the investors, because financial reports, they're not only just for a company to look at how they can improve, etc. They're mainly for the investors to look at how the company is doing, what's their decision on how much money they should invest, and they're also used for the board, the board of directors, or that's what they're called, right, Amy? What's the board called?
I think there is called board.
Yeah, the board. So the board basically can vote.
So the biggest shareholders.
Oh yeah, they're the biggest shareholders, and they're the ones that get to vote, like who gets to be the CEO or who gets to be, in the higher positions. And the next one is called financial shenanigans. This is probably a little bit better friendly one, but yeah, these are the 3 recommendations. So yeah, that is a very short class today, but that does wrap up the basics of financial analyzation, of analyzing what are the things that we need to watch out for when fundamentally analyzing a company's financial report in making decisions of whether or not you should invest in the company. All right. So if you have any questions, please put in the chat. I will be really happy to answer. If not, this is the end of our meeting, and Amy, I believe I have some announcements.
Yeah, so the announcement I have is to look out for book club meeting emails and also on the Discord. And that's about it. So I really wanted you guys to it's called Financially Literate, and right now it's not updated on the website, but I just wanted to ask you guys to keep up with their emails and also Instagram to be updated, and you can grow outside of lessons and be able to discuss knowledge amongst peers. So yeah.
Yeah, thank you guys so much for coming. We will see you the week after next. Have a nice day. Bye.
Bye.